Hello, everyone. Welcome to Scope's Portfolio Manager Conference session. My name is Manqing Sun, mutual fund analyst from Scope Analysis. Today, I'm very pleased to be joined by two guest speakers from 91, Alan Siow and Tom Peberdy. Alan is the strategy leader, Asia Credit, and co-portfolio manager of the Asia Dynamic Bond Fund at 91. He's joining us on the line this evening from Hong Kong. So good evening, Alan.
Hi, good evening and good afternoon, everyone over there.
Next to Alan, we have Tom Peberdy, product specialist for emerging market debt. He's based in London office. Good morning, Tom.
Good morning.
Today, we will look into the Asia credit, an asset class that is now simply too large to ignore. Following a brief introduction on the asset manager 91, we will move on to the discussion, starting with a snapshot on the Asia fixed income landscape and why Asia bond deserve a place in your portfolio. At the same time, I encourage all of you to type in the question on the right bar of the screen, if any. We will either answer them directly if time permits or reach out back to you with more details after the meeting. You could also view the full clip of replay on our platform Scope Explorer. For those of you who are not yet so familiar with 91, the manager, previously known as Investec Asset Management, was founded in South Africa in 1991 and initially offered strategies for emerging markets as a startup. The company successfully developed into an international asset manager with assets under management of 131.2 billion euros at the end of September 2020, serving a global client base in the UK, Europe, the Americas, Australia, Asia, and Africa. Nowadays, the broader emerging market fixed income asset class is part of their core expertise, in which they are managing 35.5 billion euros across different strategies with 27 dedicated specialists. Now, first, let's start with some questions about the team. Alan and Tom, tell us about yourself. How long have you been with 91? What is your background relevant to this asset class in this region in particular? What are your roles in the team?
Sure. Alan, would you like to go first?
Sure. So my name is Alan Siow. I joined 91 in July of 2019. I came from, prior to 91, I was a portfolio manager for the emerging market debt strategies at Blue Bay Asset Management. And I've really enjoyed my time at 91. I started in the London office with the intention of getting to know the team very well before relocating to Hong Kong with my family to help lead the charge on Asia credit.
Fantastic. Thanks, Alan. Yes, good morning, everyone. Tom Peberdy, based in the London office as a product specialist, as was introduced. I've been with the business now for around 8 years. My job's very easy to articulate. I'm here to help the portfolio managers and take as much of the day-to-day away from them, excluding managing the portfolios. So the more time they can focus on running the portfolios and the more time I can do everything else, the better for our investors.
Mm-hmm. Thank you. Tom, before we dive deeper, would you give us a snapshot of Asia fixed income landscape for our European investors who are interested to look outside the US? What are the ways to allocate to Asia credit?
Yeah, it's a fantastic question to start. Thank you. So, look, if we take a step back and think about what's available for investors in Asia credit, it's very hard. It's $1 trillion asset class. So there's $1 trillion of available debt stock. And if you put that into some sort of size context, that roughly makes it a similar size market to the US high yield market. And it's similar again in size to the emerging market hard currency sovereign market. And it's approximately double that of the European high yield market. So it's a really large investable opportunity set, which has really grown over the last decade. Now, whilst it's grown and the availability has increased, it's still very underinvested from a global investor allocation perspective. So it's approximately 5% of that entire debt stock that is actively tracked by benchmarked Asia credit funds. And that's the scope of the market. Now, whilst the market has grown, the percentage growth of allocations haven't grown with it. Overall, if we look at the quality and the makeup of that market, it's investment grade rated on average, albeit it's up and down the rating structure. So on average, it has a BBB plus rating. There's approximately 1,800 issuers across 17 countries within the Asia region, and it's very diversified by sector. So from financials, real estate, TMT, etc., all large component parts of the market. Unsurprisingly, China is the key anchor of that market and the largest component, but it's not the only game in town. So there's also allocations that can be made within Hong Kong corporates, Singapore, India, South Korea, Thailand, etc. Now, the ways to allocate, to your second question, do vary. Many today, or so far, have allocated within their broader emerging market corporate debt allocation. So it's a component part of that. But what we're starting to see more and more are investors make a dedicated allocation to Asia. It's probably the first region within EM that requires or potentially should be considered for a standalone allocation, and hence why we think it's a really relevant asset class to talk about.
Thank you, Tom. So could you quickly name 3 reasons why it is time for Asia bonds to have a dedicated portfolio allocation for investors globally?
Yeah, another good question. Look, when we think of the world, we try and think of it through a lens of compelling forces. And by that, I mean that there are 3 primary drivers of market prices. That's the fundamentals, the valuations, and the technicals. So if I give you an example in each of those of why I think investors should be thinking about it. Fundamentally, it's a very resilient market. If you look at leverage between EM and DM, EM have continued to be lower from a leverage standpoint than DM. And the standout within that is very much Asia. What you're seeing is it's the growth region of the world, and the heartbeat of that is very much China. And just to put some context around it, it's really because of the rise of the middle class that you're seeing this continued growth. So in 2020, on a global basis, Asia represents around 50% of the world's global middle class. By 2030, so 10 years from now, that's going to increase by over 15%. So to around 65%. So we're going to see a big increase in growth, and the growth engine of the world is very much Asia-centric or Asia-led. Now, on the valuation side, there's a yield advantage in Asia. It's clear to many that yields have compressed around the world, although they're starting to back up a little bit in recent weeks. But it offers a very attractive risk-adjusted return on a prior-looking basis and hopefully on a forward-looking basis. But it also offers that yield pickup relative to DM. And then that final point, that technicals, that market price behavior, it is growing, as I talked about, but it's very underrepresented. So investors can begin to get on this train ahead of the curve, and they'll benefit from the technical demand for the asset class, which will be supportive ultimately for asset prices.
Thank you. I hope the 3 concrete reasons from Tom just addressed would already get you excited for seizing opportunities in this asset class. Tom, perhaps you should raise a little bit your voice a little bit, because I think your sound is a bit low. My next question is to Alan. Despite the increasing vaccine availability, the recovery of global economies still has a long way to go with divergence over the pace. Asia has inarguably led the way in the process of normalization last year. Are there still enough tailwinds to support this positive backdrop into the new year of 2021?
Thank you. Yeah. So Asia was first in and first out, and I guess Asia, if you think about the leadership within that region, it's really been China that has, I guess, done the most. There are 2 different facets to this. One is the way countries have dealt with the pandemic. The second is their ongoing response. And I think what distinguishes Asia as a region relative to other parts of the world is they were able to respond much more forcefully. And I guess if you were to chart this out, the shutdowns were much more severe, much more rigorously enforced, and happened under much more quickly, after an arguably false start in China. And as a result, they were able to get the pandemic under control much more quickly, and therefore reopen. So the recovery that we saw last year is really a capital/investment-led recovery. That is, by definition, easier to switch on because these are large decisions made by a few people. I think what we need to see for a genuine recovery is smaller decisions made by many people. And for that, we need to see consumer demand. And consumer demand is beginning to recover in China only now, properly. So online retail sales, after having grown very fast during the pandemic, are beginning to dip. But that is now being more than offset by physical retail sales as mobility reopens. So if we think about it, the capital cycle has restarted, and we're seeing that in terms of commodity prices, in terms of CapEx spends and purchasing manager sort of sentiment surveys. But then the broad-based recovery, the consumer-led recovery, that's only just beginning. It is still quite tentative, but that is what gives us comfort and optimism about the growth for the rest of the year. The other thing to note, I guess, is led by China again, a lot of the stimulus that we've seen in this region in terms of what the governments have had to do, has been unprecedented, but it's also been more moderate than what we've seen elsewhere in the world. This is partly because these governments tend to be smaller in general, so they have smaller social safety nets, smaller in size to begin with, but also their tendency has been a lot more frugal. So in particular, if anything, China has been looking at its recovery and it's been a lot more orthodox. It's seeking to slow the pace of the recovery to ensure that there are no bubbles, no, let's say, inflationary risks, which is in contrast with many other regions where I think governments are still trying very hard to deal with the effects of the pandemic because they are not yet fully out of lockdown. So, it is they're slightly further along in terms of the picture, but we feel that there is still reason to be optimistic looking forward.
Thank you. So looking back, government bonds were considered unattractive assets, especially for developed markets where yields are low and prices expensive. Many investors are actively looking elsewhere. In this regard, are emerging Asia in the sweet spot compared to developed markets for hunting better yields?
Yes, I mean, we certainly think so. I think when you look around in terms of large, liquid, and deep fixed income asset classes that are able to be invested by a broad, range of investors, so institutional, retail, high net wealth, Asia credit we feel deserves a place on the menu. And I think that it does two things. The first thing is, there's certainly a demand for yield, but there's also the need to deliver that yield without taking overly high risks, right? And this is where I think Asia credit is distinguished because of the average credit quality being quite so high. So the asset class that we're looking at has average credit quality of Baa1, BBB plus, BBB, and this, sort of compared to global emerging market credit, which is more BBB minus in terms of the category, while offering yields of about 3% versus EM credit more broadly at 3.4. And this is without taking higher duration risk or going to an asset class that's a lot less diverse, right? So it is probably the highest quality region within EM, and EM being the region that has, I guess, captured the imagination because it's the home of so much of the growth that we're seeing today in the world. And so if you're looking for yield and wanted a slightly higher quality bias within EM, Asia is the place to find it.
Mm-hmm. So we see a trend of spread tightening. Is valuation still considered cheap? Does it still hold true that in Asia, given the sharp rally in credit spreads over the recent months?
Yeah, so this is one of the odd features of last year. So because Asia was first in and first out, credit markets and stock markets in Asia recovered first. So when we had that very famous Santa rally late in last year and also the after effects in January, Asia credit had already rallied up to that point and did not benefit as much. So as we turned the corner on the year and looked at valuations across the world, whether that's European credit, US high yield, US IG, Asia credit, so this is both investment grade and high yield, stood out in relative value terms as being still very attractive given those credit ratings versus the rest of the world. And that valuation metric has more or less remained intact, right? There's no question that fixed income in general and credit in general began the year, relatively more expensive if you look at history of fixed income, but within that, on a relative basis, Asia credit still stands out as offering some of the best value within fixed income.
Mm-hmm. So we've talked a lot about the market and asset class in general. Let's move on to your strategy, 91 Asia Dynamic Bond Fund. The question is for Tom. 91 is known for the expertise and track record in emerging market fixed income, particularly emerging market corporate debt. Why did you launch this fund, and what are the key benefits of this strategy for European investors?
Yeah, sure. Thanks. Great question. Do you mind perhaps switching to the slides for this one? I've got a slide 28, which I think would be helpful here. 28. So just as you get to that, look, I think what's important to understand is, as you said, 91 have strong expertise in this area. We've been running dedicated emerging market corporate debt. That's the one, thank you. We've been running dedicated emerging market corporate debt strategies since 2011. So essentially a 10-year track record. So we're long-term participants in this market. And as you would expect within emerging market corporate and emerging market investment grade, Asia is a large and dominant part of those investable universes. So we've been investing in Asia for a long time. But why did we specifically launch the dedicated Asia credit strategy? Well, ultimately, it was to meet the demands of our investors. We like to provide investors with flexibility and choice and the opportunity to allocate how best fits their overall global portfolios. And we feel that Asia, being a higher quality expression of broader EM, and for the reasons Alan talked about, and myself as well, the yield advantage, the support technicals, the resilient fundamentals, it's going to continue to grow. It's a high quality expression. So it was very much a natural extension of the product range that we run. Now, we run these all in the same way. It's underpinned by the same underlying philosophy and process and same team. So it's just a different expression or allocation. I think you asked around key benefits. The way we see it is we run this as a dynamic credit strategy. So as I explained, the overall market is across the credit spectrum and up and down the quality spectrum. So we're going to be very dynamic and flexible through time, protecting assets and moving more towards higher grade where necessary. And, on the other side, putting our foot on the pedal and generating strong returns in more bullish or risk-on environments. So having that flexibility, but also running a diversified portfolio that isn't purely reliant on China. So it allocates to the wider Asia region. And, the other key benefit in my mind is it offers that yield pickup for European investors. If you compare it what you can get in European IG today to even an Asia credit hedge to euros, it's a decent yield pickup over and above. So that would be some of the reasons I think I would put.
Okay, so how do you define the universe of this strategy? What are the screening criteria?
Yeah, sure. Good question again. So the JACI, the JP Morgan Asia Credit Index, that's the main indices that dedicated Asian credit investors follow. And really that's the benchmark for the fund, and is probably the best way to define the core component of the universe. Now we can add around that, and I'll add to that in a minute, but think of that as the core of the universe. And that's the 1,800 issues, 600 issuers. As Alan said, BBB plus rated, so there's a slight IG skew in quality, but we can allocate across the overall credit spectrum from IG to high yield. It's predominantly a corporate portfolio, although there is the ability within that universe to add to sovereigns, Asia sovereigns, as well as 100% quasis, which would traditionally obviously fall into more of the hard currency MB indices. As I said, very diversified across that piece by sector, TMTs, oil and gas, real estate, etc., as well by country. So it's not overly purely reliant on China. Allocations in Hong Kong, Singapore, Thailand, India. So really broad exposure across Asia. And then another component to add in is that we can have up to 20% in non-Asia. But has strong Asia links. So here I'm thinking of things like DP World, which is a Middle Eastern ports operator. Most of their revenue and traffic is with Asia, so that can be added into the portfolio. Or Suzano, the pulp and paper Brazilian issuer. Again, most of their revenue and business is through China. So the core of the portfolio is Asia-centric, but we can also have this, let's say, tactical or off-benchmark allocation to non-Asian issuers, but with very strong Asian links. And then from a screening perspective, I guess going right back to what I said at the start, we follow that compelling forces framework. So what are we looking for? We're looking for businesses through how the market prices change, driven by their fundamentals, their valuations, and their technicals. So we're consistently screening businesses on those three metrics and looking for attractively priced businesses with solid fundamentals within which to invest.
So thank you, Tom, for elaborating on the logic of your screening logic for building up the portfolio. Now, Alan, the strategy has, quote, a reduced reliance on China given the nature of granular and diversified jurisdictions within the region. On this note, which countries are of interest to you in particular? Would you give us some examples?
Yeah. There's no denying that China is a very important part of the region, but by far the largest contributor. But it's important to note that there are also a number of other interesting countries within the Asian region that add to that mix. The other thing I would stress before going into the countries is to say that our approach, specifically for credit and also for this product, is one that is driven by our bottom-up choices. So, we believe in the region, and I think this product is intended to deliver to investors a very broad and diversified exposure to the region. But we begin by selecting credits on the basis of their merits as individual credits. We look at the country allocation as almost, a second stage after we have first selected the companies. With that being said, the other countries, and these are some that my colleague Tom has already mentioned, within the region that are very interesting are Indonesia, India, Malaysia, the Philippines, Singapore, and Korea. And there's also Hong Kong, which is a distinct market, while being part of China is also a distinct economy. What ties all of these countries together, in addition to some of the broader points that Tom has made, is, demographically, these are a mix of countries that are, slightly different stages of development within the same overall arc. So they all have vibrant, fast-growing middle classes. They are, some of them are commodity exporters, some of them are more further along the technological development cycle. So a country like South Korea, for example, has a lot of companies that are leading the world in technology. Meanwhile, some of the other economies are much more traditional, what you would consider traditional EM countries with, raw materials exporters with some secondary industries. So this gives us, broadly speaking, a very big canvas to draw from, but all supported by the same very positive underlying demographic themes. So young countries that are largely growing, the growth is very widespread and coming from a low base. So as a result, it's a lot more resilient. There are lots of levers that we can pull from a portfolio construction point of view to ensure that we have, a diversified portfolio that will deliver good returns for our investors.
So from a risk management perspective, how does the team integrate long-term conviction investing with downside protection? What do you think about overall risk of the portfolio?
Right. So as I mentioned, we start, unashamedly from a bottom up, right? So we are, the closest thing, I guess, in terms of other investors that we would be like are fundamental stock pickers on the equity side. So we love companies. We spend all our time thinking about what makes companies great. And we begin by screening the universe to sort of get a sensible shape in terms of a menu to select. But we begin by very much understanding the company's position in its value chain, understanding what gives it market share, what makes it profitable, how defensible that is. So it's very traditional, but it's also very resource intensive and very, very labor intensive. And that's why we feel this is a job that we're passionate about and we love, because we think that there are very good returns to that in a universe that has a very large number of issuers, very granular, very diverse, where companies are issuing one year and maybe perhaps not issuing in another, and there's a lot of turnover in the underlying index. So for that type of universe where you're trying to find the few diamonds from a sea of available choices, we feel a fundamental bottom-up approach is suited. Once we have established that, we have a global sector-based approach. That's the other thing to say, is our selection, while for this strategy is focused on Asia, everyone who's looking at companies in the 91 credit platform is looking at them using a global ruler. So when we say, what makes this company great, we're not just looking in Asia, as some of our competitors with Asia-focused funds might be doing. We're saying, is this company truly best in class globally, and therefore does it deserve a place in the portfolio? So that is how we build up. We build up from the bottom, and when we arrive at a universe of potential ideas for the portfolio, we then apply sort of the top down, which is to say, how do we then choose from this menu of selections to ensure that we give our end clients a diversified, balanced portfolio that delivers a performance signature that is similar to the asset class, but with a very good chance of outperforming, both in terms of capital appreciation, so choosing credit stories that are likely to get upgraded, to improve, as well as delivering returns from coupons, from fixed income, which is the idea behind a fixed income, so the fundamental idea behind a fixed income portfolio. So that's kind of how we think about it. In addition, this is intended to be a dynamic strategy, because when we surveyed the marketplace and spoke to all of our investors and asked them, what is the product that you would next most likely need to meet your needs, they said, look, Asia Credit's very interesting. We agree with you. It's large and diverse. We agree with you. We like the quality aspect. But the problem that we look at there is that most of the funds that are available are only of one flavor. So they're either all investment grade or all high yield. And we're approaching a point in the cycle where we could be seeing a lot more volatility, a lot more switching. And a lot of these portfolios tend to be static. They tend to be, biased towards one strategy or the other. And we would like, a manager to have the flexibility, but also to help us manage those switches in a more dynamic manner. So from a risk management point of view, one of the things that this fund will seek to do is to use the credit lever, the allocation between investment grade and high yield, as well as the credit curve lever, whether we go long duration and short duration, as well as bottom-up selection and country selection to deliver that return through a cycle, especially when we look at the last 10 years of this fixed income bull market. And the recent market events have shown, perhaps the days of this bull period are behind us. We still nonetheless feel very optimistic that investors who have experienced cycles before, are well prepared for a rising rates environment and what that means for their portfolios, can still deliver for their end investors.
So there's another question for in terms of portfolio construction. Where do you see value across sectors at the moment?
Right. Okay. So on a sector basis, one of the reasons why I guess Asia Credit deserves a separate allocation is that it is a very diverse sectoral region. So it's one of the special regions in the world because real estate, for example, as a subsector, is quite large. This is not a sector that tends to be large in any other market, and partly that's because China is home to a very unique real estate sector, a very strong government regulation, which means that the natural provider of debt finance to the real estate sector, being banks, are not able to provide as much finance as they want. And that's because the Chinese government is very keen to ensure that there are no asset bubbles in physical real estate. So as a result, many of these companies come to the bond markets where they otherwise would not need to in other regions. And so real estate is a very interesting sector within China, both within investment grade and high yield. So it's an opportunity for global investors to take advantage, to arbitrage really a decision made by a government to try and prevent, from a macroprudential basis, asset bubbles within its borders. It gives us an opportunity we might not otherwise have. The other sectors that we feel are very interesting on a global basis are technology. Two of the world's most prominent technology companies, Alibaba and Tencent, are present in this market as bond issuers, and they offer spreads despite being similar credit quality to many of their American counterparts, the Googles, the Amazons, the Facebooks of the world, the Apples even. They offer very attractive spreads for the same credit rating. Likewise, you have a very large number of telecommunications companies, financials that are very strong regional champions or domestic champions that offer very strong and stable returns. And this is probably another point that I think it's worthwhile just highlighting the difference that Asia credit is not like Asia equities, because if you think about it, the average company that needs access to the dollar credit markets, it's not the same type of company that has an equity listing. So many companies that are present in the domestic equity markets tend to be companies that earn their revenues in domestic currencies, that have mainly an inward-facing business, so their main operations are local. Whereas Asian companies that issue bonds in dollars tend to be exporters, they tend to be multinationals, they tend to have revenues that are denominated in hard currencies, and they tend to be the biggest and best companies of the region. They also tend to be companies that require dollar funds for capex. So think about utilities, think about banks, think about large telecom operators. So these are companies that may not be exciting equity stories because they're not fast growing, but they are very attractive bond stories because they're usually very strong. They have very powerful market share. They have strong and stable cash flows with high visibility. And these make them excellent bond issuers. So those are a selection of the sectors that we find to be quite attractive. I also wanted to take a small note and say that metals and mining is also a very meaningful sector within Asia. This is a sector that obviously is ESG challenged, but even within Asia, there are these companies are meeting these challenges head on. After a long period of engagement, I think they're learning their lesson and also repositioning their business away from very clear ESG risks. This is a sector that I think is developing very quickly at the moment. We are following the sector very closely in terms of looking for opportunities that would be attractive, having taken into account the ESG risks.
Very interesting point. So let's wrap up today's discussion with two questions, one on the past and the other on future outlook. I don't know if you recall, we have a sort of a haunting flashback when Asia was hit by somewhat similar epidemic called SARS in 2003. Do you think there's a lesson learned in the market from a fixed income perspective, and what is different this time for COVID?
Yeah, look, I don't know if there's a special lesson just for fixed income, but I do think that there definitely have been lessons learned. As a person who has just relocated to Asia from London, I have experienced COVID in two continents. And it's been very interesting just to see the difference in behavior and habits. I think SARS definitely was habit forming in Asia. So governments and people here have behaved a different way, and their memory, both institutional and social, is so strong. So I think, things that, we probably take for granted in the West, just happen, out of, as a matter of course here. So people are much more careful about washing their hands, about wearing masks. In fact, the joke that I tell a lot of my colleagues is, at the start of the pandemic here, the Hong Kong government said to the population, because it was then concerned about the impact on the economy, you don't need to wear masks. The situation is under control. And what did the population do? They said, we don't believe you, and everyone wore masks. Whereas I think the reverse happened in Europe, whereas the government was saying, oh, you should wear masks because this, could be a problem. And everyone said, no, we don't believe you, and didn't wear them. So I would say that the habits here are, once bitten, twice shy. And so there is, if you like, a skepticism, a very healthy skepticism. People are very concerned about their own wealth and their own health and well-being. And as a result, they're much more conservative. And so the governments, frankly, had to do less because the people were already positioned in a certain way. Their posture was already ready for this. And as a result, financial markets were less affected because, the key thing in Hong Kong that everyone talks about is properties. Just like I'm sure they talk about the same in London and in Germany. And people, were obsessed about house prices. And everyone learned a lesson from SARS, which is don't sell your house because, the SARS point was the best time over the last 10 years to buy property. So when I came, everyone was saying to me, if you see any good offers, you should definitely buy. And as a result, there were, of course, no offers. Likewise, I think the markets experience a much more benign drop because of this. People were conditioned to accept that. And it was only later on when COVID became a global pandemic that I think financial markets were truly affected. So the lessons here, I think, is that the good news is, if we can say that, is that the world is now inoculated in much the same way that Asia had been inoculated by SARS and by other regions. For example, MERS in the Middle East. We've seen regions that have experienced when you've experienced the pandemic for the first time, you are then much more prepared in the future for such an event. So, gives me room to be optimistic about the future of our experience now.
Thank you. So what can we expect in terms of policymakers when it comes to Asia, especially China? The PBOC has been trying to clean up the credit market by consolidating and deleveraging. Now there's also a fear on the street that PBOC is pulling back on stimulus. How would that play out? How will you look at it?
Yeah, so this is the other, I think, aspect of this. So China and to a lesser extent other countries in the region are, one of the last few markets with orthodox monetary policy, right? So China is a market that has positive real rates, where inflation is still very much under control, where the economy is recovering at a very fast pace, and where policymakers are worried about overheating. The currency is currently in a very strong position. And so I think what we should take some comfort from is that there is still a lot of stimulus left in the tank. And the government in China is certainly trying to balance the needs of ensuring a good recovery, but also ensuring that the recovery is not too fast, right? And unlike other regions, because it's still operating in a positive real rate environment, there's still a lot of tools. And as a result, that gives us a lot of comfort that regardless of the path of future growth in China, that, absent a very large policy error, which we don't expect, there is a lot of tools left in the toolkit for them to use in case they would need to. Looking at the credit markets, there's been a lot of, press coverage of the rising defaults in the region, particularly in China. I think it's important to note that a lot of these headlines focus on the fact that, there are now defaults where there were none, but the actual level of defaults in terms of as a percentage are still very, very low. And this is because China is still a fixed income market that is very immature. It's very large, but it is only now emerging, and foreign investors are only now arriving. And as a result, a market where, there was a very strong government protection over a long period of time where defaults did not happen, in order to go towards a more market-oriented outcome, we need defaults, because defaults are the way that the market works. That's how good companies are rewarded by lowering the price of at which they can borrow, and bad companies are punished. If there are no defaults, there is no difference in price, and then the market cannot operate effectively. I think the Chinese government knows this, and it is allowing defaults to happen. So this is an intended policy outcome. So we welcome it, because we feel that as bottom-up investors, this will give us the best chance to generate good returns for our clients in a market that has more dispersion, and where a healthy operation of the market is to be expected to allow it to grow and develop further in the years to come.
Thanks, Alan. So overall, attractive valuation, relatively low correlation to the rest of the world, and positive technical backdrops really put Asia in the sweet spot for more growth stories. Unfortunately, we have to stop here in the interest of time. Many thanks again to our two guest speakers from 91, Alan Siow and Tom Peberdy, for such brilliant presentation on the Asia Credit and Asia Dynamic Bond Fund. I hope you enjoyed today's Scope Portfolio Manager Conference, and have a wonderful day, and see you next time.
Thank you.
Thank you, everybody. Thank you for your time and attention.